It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital, and joining me, the man himself, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. How are you? How are you doing here now as we're kind of rounding into 2021?
Well, we're kicking off the first Ask Mike Monday of the year, and I think if it's any indication of the first couple of weeks have been, I think we're hopefully going to have a good 2021. I mean, I'm seeing still interest rates creeping up a little bit, but still remaining very, very low. And the appetite for the agencies, Fannie Mae and Freddie Mac and FHA, still is insatiable. So I think I'm very thumbs up for 2021 so far. How about you?
Yeah, things are off to a pretty good start. We're trying to get home on a couple of deals right now, which we're in kind of process of, and hopefully look to do a few more things. We got a 1031 that we got to help with one of our clients, and so we're kind of actively out there looking for that, and then still trying to find some high quality opportunities to put out to the marketplace and raise some capital. So it's been a pretty good start to the year so far. Hopefully the activity level stays high and we'll continue to be successful. It seems like the appetite from investors and capital and debt all seems to be pretty favorable, and for the most part, we're holding up pretty decently with collections. So we'll kind of see how the $900 billion stimulus passed in December as that starts rolling out. At least the rental assistance portion of that starts rolling out, how that works, and we're able to kind of keep our operations together until we get on the backside of this vaccine rollout, and summer to early fall is kind of what everyone's predicting right now. So we'll see. Cautiously optimistic. I think long term we're primarily focused in Texas, as you know, and my company at least. So the view from my seat's pretty rosy from kind of even the near to intermediate to long term. So I'm sure other people in other locations are maybe a little bit gloomier than we are here in Texas, but so far so good.
Well, that's good. And the reason why we talk with Michael Becker and his group over at SPI is Michael is a former banker, and he worked for one of the largest multifamily commercial real estate firms in the nation. And he was the guy who was giving the money out, and he transitioned a number of years ago to become an operator. He became a multifamily giant in the Texas area. He's gone on to do 10,000 apartment units. So we find tremendous value of his feedback about what's going on for some of the questions that folks in the audience ask. So it's kind of a unique piece is that Old Capital, that's us. We do the lending. Michael Becker does the operating. So we have a unique perspective about what's going on in the marketplace. If you think we bring value, we would appreciate going on to the oldcapitalpodcast.com, oldcapitalpodcast.com. Download the 17-page white paper report on multifamily financing 101. I think that would be great for you to learn in your journey being an investor on multifamily. We bring in 75% of the money. Learn from us about what's important when you do it. Second thing is, if you think we do bring value, go into iTunes and leave us a 5-star report. We do certainly appreciate that. We're trying to get 1,000 before the end of the quarter, so that would be great if you could help me with that. So this is the time that we ask Michael all these great questions, and we wait for his answer. So we go to Muhammad on top of the mountain. So Michael, I learned through stories. Any good deal stories these days? So that's a question. Any good deal stories, Michael?
That's a broad question here. I think I also like learning through stories and learning kind of what other people talk about, and kind of hearing some of these deals, the kind of the evolution of the workforce housing space in particular, which is what you finance and I used to finance so much of, and we used to own a whole lot of, and don't really own as much anymore. You kind of hear all these crazy stories about deals that we bought for the $25,000 to $30,000 a door range, now trading for $100,000+ a door 8 years later. And I kind of heard the other day, I had one of my broker friends, they actually ended up owning a deal down the street for one of our deals, and they're trying to sell this really, really tough property just right across the street from a deal that I own that I looked at, I don't know, 8 or 10 years ago. And it was 20,000 a unit. And now it's going to trade for, 95 to 100,000 a unit. It's got a chiller and a boiler and deferred maintenance. And it's a whole bunch of tough stuff that's kind of really, is just amazing to see the evolution evolution of our space and how much more capital has really kind of come in. And, I know one of the deals that kind of comes to mind, you threw me a curveball there, Paul. So one of the deals that kind of come to mind is, years ago, I think it was the fourth property we bought, the property in South Irving. We ended up, I think, paying it was like 260 units. So I think we ended up paying around like 29 or 30,000 a unit for it, about $8.6 million, if I recall correctly. We ended up owning it for a little less than 4 years. I think it's about 3.5 years, put a bunch of money in it. The deal at the time we bought it was like a perfect value add. The rents were probably 25% below market. They weren't billing back the utilities, so there's no RUBS in place. So it's probably like another 10% of income. The utility bills were out of control. And then they had, I think, 5 or 6 non-revenue units. He had it was more like 10 or 12. He had like 5 units that were down just because they had like roof leaks, and he just like didn't fix the roof leak. He just kind of kept the unit down, pulled the sheetrock out. He had another 5 where he had like 4 of his employees live for free, not discount for free. Plus was like a horse trainer. So then he had his jockey live in a unit. So we had 10 units we could just bring online and get revenue. We had, 10% in income from RUBS implementation and probably 20% upside on rent. And then so we ended up, buying it, more than doubled the NOI in our 3.5 years. We sold it for like 72 a door and for like 17.2 million. So it was like 8.6 to 17.2 in about 3.5 years. And we thought we were great. Well, then that deal traded about a year ago, I guess now. And the new buyer, I think, paid about 102 or 103 a door. And the guy who bought it for me did operated it okay, but didn't really spend a whole lot of money, and kind of really just kind of rode the market a little bit. And but I think he was able to increase his income by 25-30% over the 3 or so years that he owned it. So it really kind of was making me think a lot lately about just kind of the evolution of the workforce housing market space and my tenure of doing this and owning, and back before that lending, just how much things have really changed from how much more sophisticated the ownership groups are today with the technology we use and the management companies in place to, how many more people are in all the markets that we play in today. And then how much more capital is really there, and kind of, the ability for platforms like ours to get the word out about it, and how much more interest there is in the space, and how many new participants are coming in from both the limited partner kind of passive investor side, and then how many more sponsors are out there in the marketplace. And I know you see a whole lot of those, Paul, in your day to day, but that's really kind of been a little illustration of some of the stuff that's really kind of gone on in our marketplaces here in the last 10 years.
Let's talk a little bit about, we talked a little bit about C property, and you guys have done a tremendous job going from C up to A minus. How do people scale their business?
Yeah, that's kind of the interesting thing. I spoke to a group the other day. I got invited to go speak to 25, 30 syndicators that are trying to that have actually done deals and are looking to kind of scale their business up. And that was kind of one of the topics that was the most interest of them, is you've done 4 or 5 deals. How do you go to do 50 deals like we have, and we manage 26 or 7 or whatever we manage today. That's really kind of been the more difficult part of it, because I was always a deal junkie, Paul. As you know, I was a guy that did a lot of deals when I was a lender. So when we started out doing deals, we're sort of kind of like I'm like a duck in water a little bit, when it comes to doing transactions. But how do you take all that stuff once you do it, and then manage the million investors that you get, and all the we're doing literally, I think, 1,340 K1s as we record this right now. We're gonna get all those out by February. How do you get all that out and stay organized and communicate with the investors and pay out distributions every month, and all those, hundreds and hundreds of thousands of dollars in distributions every month? And how do you do all that and, have a life? So that's kind of been the interesting part of it. Just really kind of, it's really about just being methodical and getting organized and documenting all your processes, and then, keep trying to re-engineer your processes until you find something that works a little bit better, whether it's hiring more people, which we certainly have done, and then, upgrading people over the years, making sure we get the right people in the right positions. And then, some of this is technology. So fortunately, there's a lot of technology out there that really helps you with your investor relations and organizing all your distributions. That helps. It makes it a little bit easier for tax time. So we have a little bit of a mixed bag where between technology and people. It really kind of helps.
Yeah, you guys, when you first started, and that was a number of years ago, that there was not the technology in the management software that would collect all the data for the PPM and all the investor data coming out, and wasn't able to push information out to the investor database. So you guys were doing it yourself. So my question is, Michael, at what period of time do you go from 0 employees to at least 1 employee? And what's that first or even the second employee? What were they in your group?
When we started out, it was my partner Sean and then we had 1 employee kind of out of the gate, kind of helped it. It was like analyst / transaction person, did a little bit of everything, and then we started with some administrative help, and then we got the lady who's now our director of operations, and she really kind of came in and started transforming our company. And we were just guys that had a bunch of deals and didn't really have any infrastructure or organization to it. So then we just kind of methodically went, kind of category by category and really kind of putting together some infrastructure and documenting it and putting policies and procedures in place. And then, got some more administrative help and then asset management help. And, now we're getting some people to help a little bit more with just taxes only, even though we outsource the taxes CPA, but kind of it's the current role we're actually actively hiring for now. And then we're going to get a formal investor relations person after that to really kind of help take a lot of the day-to-day slug of reporting off of my shoulders. So it's just been kind of a process kind of rolling up. And, when you start out, Paul, you do a little bit of everything because you don't have any real revenue to do. So you do the $10 hour tasks, you do the $10,000 hour tasks, and kind of everything in between. And then that's the first thing I would probably do is try to get some sort of administrative help to get some of the lower value tasks off your plate that just need to be done, but that's not really where you make money in this business. So that's probably the first place I would start. And then when you get to 6-7 deals, really getting some asset management help, I think would be something I'd probably go back in time and bring that role on a little bit quicker and really try to make sure we got some extra eyes on these deals. Because now not only do we have an asset manager, we have an assistant that works for him, so we have kind of layering and scaling as we get bigger and bigger.
So also, people learn from stories, and you guys are in the process of being a Freddie Mac Select sponsor. What does that mean?
That's there's, from what I understand, it's kind of like the country club within the country club, as you say. There's 100 of them in the country, and hopefully we make the cut here in the near term, and been working at it. And so really, if you are one of the larger borrowers, I think they only have, like I said, 100 of them in total across the country. So they want to have, can't remember exactly what the number is, but $100 million in average borrowings a year for the last several years and expectations going forward. So that's kind of really, they want to make sure that the most active clients of Freddie Mac. And then if you're in the country club, you kind of get a little better pricing, which I think we're probably already there for the most part on the pricing side. And then you get some other perks like negotiated loan docs and a few other things on the underwriting side. That the pricing being the biggest thing in my mind, that the biggest value or benefit of being in there. So I think that's certainly an aspirational goal. If somebody wants to really grow and scale, that's certainly something to kind of get into one day. Then so we've been working on that for 2.5 years trying to get in there, and I think 2021 is our year, I hope.
You say that multifamily is an incredibly unfair business. Is that one of the unfair businesses features that you're going to have to invent?
For sure, right? If I can get 20 basis points lower in my spread than the next guy on the same deal and the same loan, then I can return that much more capital, and I have a much better chance of winning the deal up front and then delivering better returns if you can get better pricing. So yeah, it's a completely unfair business, and the bigger you are, the more deals you've done, the better the debt terms tend to get for you, for sure. And you could probably talk about that, thousands of times over with your clients, Paul.
Let's talk a little bit about challenges. Again, people learn from stories, challenges that you guys had, say, recently on a transaction that you guys had SPI had put together in the Dallas area. It didn't have to be Dallas. It could be Atlanta or New York or wherever. But you guys put this transaction together, and it was a TIC structure. Tell us a little bit about that one, because I think that's interesting.
Yeah, so Paul brought this up the other day. He's got a client that's doing a Freddie Mac small balance loan, and they have a tenant common or TIC structure. And we're having dinner the other day, and I was just telling Paul, like, oh yeah, that's your problem, because Freddie Mac doesn't like having these TICs, whether you have one person with experience and then the other person without experience. Because in the TIC, each partner owns a percentage of the real estate fee simple. So if I bring in 40% of the money and Paul brings in 60% of the money, we'll have two separate deeds of trust, and I'll have a 40% deed of trust, fee simple interest in the real estate, and I'll have 60. So at the end of the day, to sell it or refinance it, you have to have unanimous consent. So they don't like having someone without experience, potentially messing their loan up or impairing their ability to do it, because they're banking on the more experienced sponsors. So we had a deal that we closed in the summer of 2020. It was our first deal kind of post-COVID, and that we had a 1031 client. So we ended up having to ultimately bring an entity I controlled to become the non-managing member of my partner's LLCs or LPs, whatever they were. So we had to have an entity come in and become the non-member manager of his entities, satisfy Freddie Mac. And that was different because we had done prior TICs, either with bank loans, with a Lifeco loan, and with Fannie Mae, but we didn't have ever done a TIC, I guess, for whatever reason, with Freddie Mac. So that was an issue for them, and it was an issue for Fannie Mae. So if anyone's listening to this and is going to do a TIC and you want to do Freddie Mac, that's certainly something to maybe reach out to Paul, because now Paul's intimately knowledgeable about how that works too, because it's kind of one of those things that you think you've seen everything, and all of a sudden something new pops up, and you learn along the way too.
What'd that cost for legal?
I don't know, tens of thousands of dollars between, our lawyer, the bank's lawyer, and our partner's lawyer. And then we all had to have these, $1,000+ hour calls when you get three lawyers billing you at the same time. So those are always fun when you get three lawyers on the same call and you're just seeing the billable hour rack up.
So that was a big transaction for Mike and his TIC partner in that transaction. So, I think the takeaway is it could be done, but it takes some structuring for it to be done. In the transaction Michael and I were talking about last week, the one I was having a problem with, and I still have a problem with, is a TIC structure in a Freddie Mac small balance. I'll go on to tell you that if you're thinking about having a partner that, let's say they're buying a property in Dallas, and the TIC member that's bringing a lot of the capital into the deal, say, is in California, and they're bringing their money in to satisfy the structure, that guy better have enough net worth, liquidity, and experience to kind of try to qualify by themselves. So if they don't, that's going to be a problem. So if you think on one side that the entity is buying the deal, and the other side is the TIC person or entity, that TIC entity just can't be there for just to throw their money into a deal. They're going to have to qualify for that deal too, based on that net worth, liquidity, and experience. That sometimes is difficult if you sold a duplex in California and you raised $1 million and you want to put it into a $10 million, $15 million deal in Texas as an example, and you don't have the net worth and liquidity to do it, to qualify by yourself, you're going to have a difficulty one with the Freddie Mac small balance. Ask us, we'll tell you. And so that's going to be a difficult one to get done. So, we rub shoulders with a lot of interesting people in the multifamily space. And one of the things that I think we learned a lot from is a recent interview you did with Nick Flewellen over at Marcus Millichap out of the Dallas office. Nick is one of the top producers across the country. He's been in the multifamily business, selling multifamily properties. He's also an operator too, and kind of understands a little bit about the basics about what's going on. And there's a great value that Michael had on his show. And Mike, tell us a little bit about your interview with Nick Flewellen.
Yeah, as Paul mentioned, we played a prior episode where we had Brian O'Boyle on, but I started a kind of a complimentary show to the Old Capital podcast that Paul and I have been doing for 6 years, but it's called the Multifamily Investing Show with Michael Becker. So I know it's a really original name there, but you can find it on iTunes or Stitcher or YouTube. Really, it's kind of as a video, it's in a studio, highly produced. Or our website is www.multifamilyinvestingshow.com. You can go there and find it there. But really had Nick on a few weeks ago, I guess, as we record this now. And Nick kind of talked about kind of the evolution of the workforce housing space. And he talked about a live deal that he was in the process of selling, which I think has got put into escrow or at least awarded at the time of the recording here now. Just kind of really talked about kind of this, the things that have changed in his career. He's been in the business for 17 or so years now, 18 years now, something like that. And he's, really kind of just got in out of college. And, one of the things I found interesting, Paul, he talked about when he first started marketing these deals, so easy now to kind of get aware of all these deals that are for sale in the marketplace. You sign up on these distribution lists and get an email or your inbox and get all these deals from all over the country. Well, when he started out, I used to kind of do the fax blast instead of an email blast. He would do a fax blast. So you literally sit there and they type in, 1,000 numbers in a fax machine and, kind of hear the dial-up tone and, kind of the fax going through and just kind of, one after another. That was, just kind of something simple like that. Like, how does he even distribute the knowledge that there is a deal out there? So just kind of the information and technology has really progressed so much that, in his career that you can really get the word out and really kind of has driven a lot more interest into our space. And so he's got a lot of knowledge and really kind of has done a great job of branding himself and, doing a lot of workforce housing and Dallas-Fort Worth. And then really him specifically built a team out. And now they do a bunch of deals in secondary markets throughout kind of the general region, not even just the state, but even the general region going to other, kind of neighboring states and maybe states, one or two away as well. So Nick's got a wealth of information. He does as much workforce housing is pretty much anyone in town. So if you guys listen to the remainder of this, we're going to replay the show here, and I think you'll find a lot of information from a guy who's sells as much as anybody. He's extremely smart, extremely smart.
Yeah, if you're thinking about getting into the Texas area, Nick is the guy you want to talk to probably first, or on his team. He does a great job. One of the things that I also want to talk about, which I think I forgot to talk a little bit about at the beginning, if you're listening this long, pre-COVID, there was a shift to secondary markets in search for yield. But now, hopefully, it's post-COVID, and the benefit of work from home and the renters searching for lower density properties into the secondary market. So on the Old Capital Speaker Series on January 27th, Old Capital Speaker Series, we're going to have some of the top brokers talk a little bit about some of the secondary markets, what are some of the benefits. If you're an investor, what are some of the things you should be looking out for before you make a large investment into a secondary market, especially what you should know about for financing, which should know about for underwriting these deals, what is important. So make sure you go to Old Capital Podcast, oldcapitalpodcast.com, and sign up for this free once a month show that we do, and you definitely want to be part of that, talking a little bit about secondary markets, about what's going on. Michael, what does SPI do? I'm a little bit confused. Can you give us an idea?
Yeah, so my company, SPI Advisory, really what we do is focus on putting together high quality deals and putting them out to our database and raising capital and operating them and hopefully successfully and returning more money in the future. So if you guys want to find more information about us, the easiest way is go to our website, which is www.spiadvisory.com. That's SPI like spy, advisory.com. There's a contact us form, fill that out. And I'm always happy to send out a little bit of information about what we do if you guys are interested in kind of learning about future investment opportunities as we put them together.
And now, with Michael's permission, we'd love to play and for you to listen to Nick Fluellen with Marcus and Millichap in his interview with Michael Becker on Michael Becker's show. So thanks for listening. I'm Paul Peebles. Michael Becker there. Have a great day.
Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm Michael Becker. We're here for episode 4, and I'm real excited today to have my good friend, longtime friend, Nick Fluellen. Nick, appreciate you coming on.
Thank you for having me.
Yeah, Nick Fluellen's senior managing director for the Fluellen Hoover team at Marcus & Millichap, based here in Dallas, a few miles away from where we're talking today. So thank you for coming in on a rainy, cold day here in Dallas. Maybe just give a little quick background on yourself, Nick. I know we've known each other a very long time, kind of came up with the business around the same time. Maybe just give a little brief background on kind of you guys and what do you guys focus on?
Yeah, so I went to Texas A&M and decided to stay in school and get a master's degree in real estate finance, basically. And so straight out of that program in 2004, I started Marcus & Millichap, and It was a great time to be starting in the multifamily business. It's funny because, it doesn't seem like it was that long ago, but the technology has evolved so much in that period of time. But I mean, at that time, we weren't even doing e-blasts. We were doing fax blasts. And I mean,
you would literally fax your listings.
You would literally sit and type in 1,000 numbers in a fax machine and send like a little one-page flyer and then push go and listen to it dialing all these numbers. I mean, so pretty remarkable shift in technology.
Yeah.
Nobody had a GPS. Nobody had anything. I mean, so we were looking at rent comps on a Mapsco and trying to drive around and figure out where everything was at. So
you still remember the grid number for South Irving? Where you probably sold
you know what? I've long forgotten that. But at one point I could have probably told you all kinds of weird things like that. And so anyway, it's been a lot of fun. We started off doing any and every deal we could get our hands on, and have grown with clients over the years, and didn't take long at that point in time to start getting into kind of 100+ unit stuff. And obviously over time, the deals have gotten larger and the values have gotten higher. And so been really fortunate to be in the same place now for coming up on 17 years.
Wow.
And grown a big team. And my partner, Bart Hoover, and I have 17 people on our team, primarily focused on Class B and Class C and DFW. Of all sizes. We have a segment that focuses just on 75 unit and under deals, which we love kind of getting to know investors as they're doing their first deal, and then hopefully to keep growing with them as they get larger and larger over the years. And then our biggest opportunity, I would say, or an area we're really excited about has been in secondary markets. As DFW has gotten so hot, we have a number of people that are frustrated because they can't win deals, or they don't want to win deals at the prices they're trading for. And so to be able to take them and put them in some different markets is something that we've really spent a lot of time and resources on, and are seeing a lot of success in that area.
Yeah. So I went to your website to kind of you have a pretty good website with some history. And so, multifamilyadvisors.com.
Multifamilyadvisors.com. Everybody always asks, how'd you get that? I was like, well, that's because nobody was on the internet back then. I bought it a long, long time ago.
That's right. So Nick does a pretty good job of tracking his history here. So I went through a little history lesson. So you started in 2004. You did $5 million in sales your first year in business. Was that a full year, partial year?
2004 was about a half year.
About a half year. Okay. And then you peaked out kind of pre-Great Recession in 2017 at $115 million in sales. Hit the trough in 2010 because that was the worst year, was 2010 at $43 million. And what did you guys do in 2019, and kind of where do you see 2020 finishing out?
Yeah, I think 2018 we were right at about 500. 2019 maybe a little bit less than that, and that can ebb and flow. Of course, just depending on what deals you do. And then this year we'll be over 600 million. I don't know. We'll see if we get to 650, depending on what closes. So yeah.
So from 5 million to 600 million in about 16 years.
Yeah, and of course the size of the team has certainly grown. And quite honestly, the same deal that we were selling, back in 2004 is probably worth 3 or 4 times.
Sure.
In some cases more what we were selling it for back then. So yeah, a lot of different factors, and I'd like to think we've gotten a little better at what we're doing overall this time. So yeah, it's we've done about $3.5 billion in that period of time. Very little of that is portfolios too. So that's pretty much all on a one-off basis. That's 500+ transactions. So yeah, it's been a wild ride.
Seen a thing or two. So
seen a thing or two.
So I think what we really want to focus the bulk of the conversation on today is really about the evolution of workforce housing, kind of what you talked about. But maybe before we get into that, maybe just talk about like the drivers. So you focus on not only Dallas-Fort Worth, but now really a lot of secondary markets in and around kind of the North Texas region, and you've even done stuff in New Mexico and Louisiana, and Oklahoma. So kind of
Kansas. We've done some deals in. Want to do more in Mississippi. So yeah, we're really all around Arkansas. We're working on a handful of deals in Arkansas right now.
So what's really driving people here to kind of our region, but maybe talking a little more specifically about Texas and Dallas-Fort Worth. What is really the drivers in your mind, and why is capital coming here? What is your questions that you get asked when these people are first coming to town? Why are they here?
Yeah, well, I think. Of course, a lot of folks from California have come to DFW, and that's been the case really my entire career. I think we had a little period of time where the local investors, and still that period is probably going, where local investors are far more active and there's more of them. But I think, we're a very business friendly state, very landlord friendly state. We are attracting a ton of new companies. A number of big Fortune 500 companies have relocated here. Charles Schwab, AT&T, Toyota, State Farm, PGA, and the list goes on and on. And there are literally hundreds. And cost of living, very inexpensive. It's just a great culture. Doesn't look like California, but it's if you're a business owner and you're trying to figure out a way to give people good wages and an affordable quality of life, it's a great place to be. And that obviously carries over the population growth and the income growth carries over into the multifamily world. And so that's what we've really seen. And people get here and they're like, wait a minute, I can get a tenant that's not paying rent out in 3 weeks and for $150. I mean, that's night and day. I mean, we hear stories of people paying $50,000 for somebody to go away, in other states just because they could be in that unit for a couple of years without being able to get out. So that's really appealing for people as they're coming here for the first time.
So kind of the theme of the evolution of the workforce housing space, who was buying the first deals from you in 2004, 2005? Maybe talk about 7-8 years ago, kind of who was buying that, and then who's our market participants today, and how's that kind of changed or evolved over the last 15, 16 years of career?
Yeah, it's an interesting question. It's as I was just looking at some data prepping for our time together today. A lot of those buyers back then, it was not unusual at all for us to see a California buyer who we'd never heard of before, and maybe a 1031 buyer. Maybe someone who, just sold a duplex or fourplex and was going to try to move that money into something bigger. And
they sell a duplex in California, buy a 50-unit deal for
that's
you.
Right.
And
that's right.
Fort Worth.
That's exactly right. Even one of my good clients now, who I'm doing a transaction with right now, I mean, they used to buy small deals here, and now they've sold a lot of the smaller ones and have transitioned that into larger assets over time. So I think that was the type of profile. We had a couple of regional type operators that owned a few deals in DFW back then as well. But in general, of course, our clients were certainly more private back then. I mean, we still have a lot of those clients today, but some of the bigger, more regional type players. But it was a lot more people that were spending maybe their own money at the time. And that has evolved over the years. We had a period where, you'd see more syndicators come into the market. And then here in the last maybe 5, 6, 7, 8 years, the rise of kind of the local investor and the local investment groups who are pooling money together and some of the different educational programs that are out there, that's led to a massive increase in the local buyers, being the ultimate winner, even not on a $5 million deal, $10 million deal. I mean, they're winning $25, $30 million deals and on up from that even.
And are we seeing like foreign buyers coming to buy Dallas Fort Worth workforce housing? Was that ever a thing? Someone from Japan buying a deal 15 years ago?
Yeah, we have sold 15 years ago. No, we weren't seeing a lot of that. I would say certainly in the last 5 to 8 years, definitely seeing far more of that. We've sold a number of deals to Japanese investors. We've certainly had some Middle East funds that have been placed over here. Canadian funds as well. That's and our firm specifically has really made a significant inroads into Canada and opened up a number of offices there. And so that's definitely led to more eyeballs on inventory down here. Definitely, I wouldn't say that's who we expect the buyer to be, but we have some good contacts and good clients on the international front, and occasionally they'll call and say, "Hey, I need a deal," and we kind of know what they're looking for, and have had some good success in putting them into some of these type of deals.
As kind of wrap this part of the conversation up, are we still seeing a lot of California 1031 buyers like we did 12, 13 years ago before everything blew up?
Yeah, I mean, I would say in general the answer has been no, but But I will say specifically with Marcus and Millichap, I think we probably see more of it than anybody else does. Our firm was based in California, founded in California. We have a number of offices in California and a huge sales force out there. And the way our corporate culture works is really a culture of information sharing. So, you know, we had a deal that fell out when COVID first hit and the world shut down. And two of our top guys in the firm who happened to be in our Palo Alto office called and said, hey, we've got a high net worth client of ours who really wants to move money to Texas. And they ended up, you know, coming in and buying a $39 million deal with a line of credit. I mean, yeah. And then we had another guy in our Seattle office that called and said, hey, I got a 1031 guy, doesn't want to be in Seattle. Would love to kind of get money in Texas. He ended up buying another deal of ours. So we do see more of it probably than I would say that the DFW as a whole sees. Yeah. But that's not who we necessarily expect to be our buyer. We do have another deal actually, as we're talking about it, that's getting ready to close here in the next 2 weeks. That's also a 1031 buyer out of Utah. So it's out there, you know, but not necessarily
half the market like it was 4 years ago.
Not like it was then. Yeah. I mean, that was kind of the expectation. So we'll get a 1031 buyer. And a lot of times, you know, really thinking back to 2004, 2005, 2006, you know, we weren't really doing call for offers dates then. And we weren't, everything had a price on it then. Yeah. So it's a very different time now than it was then. Whereas, hey, we want X dollars for this deal. Oh, I'm a 1031 buyer. Yeah, I'll pay X for it. And there was no date that we were building up to. So those deals were a little easier to do. Sure. You always have the timing issues with a 1031 now. And so those are just a little more tricky and challenging if the timeline doesn't line up perfectly.
So one of the things I know we've talked about several times in the past is really kind of the cap rate compression that we've seen quite a bit, where the property grades from the A to the C used to be, you know, 300 basis points or more from the Class A to Class C. You would get, you know, maybe an 8 cap or better on a Class C deal. Maybe a Class A deal was a 5 cap, and now everything's pretty much on top of each other. And we talked about the evolution of kind of some of these investment clubs and the amount of capital these guys can raise. One of the things I always we've talked about in the past is kind of you have some of these like annuity deals where you've sold the same deal 3, 4, 5 times. You know, I know you sold the Azul in Northeast Dallas County over there, Northeast Dallas kind of Lake Highlands area. And then I noticed right now you guys currently have a listing Diamond Lock out in North Richland Hills.
That's right.
And this is probably your 3rd or 4th time selling it?
Yeah, it is.
So I thought maybe we gotta kind of go through the evolution of maybe that deal. Diamond Lock's probably a pretty good example. Maybe talk a little bit about that deal, kind of the stats of it, and when did you first sell it? When have you sold it again? And kind of what are we anticipating this thing about to go for right now?
Yeah. Well, Diamond Lock's a fun example because that was literally the first ever 100+ unit deal that I ever sold in my career. Okay. So, you know, and so that was, we sold that deal in January of 2005. So I'm 6-7 months into the business at that point. January of 2005, we sold that deal for $32 a door. I went back this morning and looked at our old underwriting, which that's a whole nother conversation, but
a little bit different now.
It's a little bit different now. And a couple things I was really looking for is what was the average rent on the rent roll. And that was, let's see, $695 was the average
$700.
$700. And these are big units, right? So that was pretty low. And then the debt is the other thing I was looking for. Yeah. We underwrote 6.8%.
Okay.
No IO.
Okay.
And 75% LTV.
Okay.
You know, so
that would have been a bank loan most likely.
You know, it was probably LaSalle. You know, at the time that was kind of a lot of people's go-to lender. But anyway, I mean dramatic difference. I remember that being a pretty desirable deal at the time. Nothing like what we'd see today, but you know, it sold, and then. Years later, fast forward, I think 7 years. Let's see. Yeah, January of 12.
Okay, 7 years later.
Okay, so that deal sold for $45,000 a door.
Okay.
So nice, you know. I mean,
about a third up.
Nice gain, you know. The average rents weren't that much higher. They were $730 at that point in time. The debt that we underwrote was better, 5.5 5.3% interest, no IO, right? So again, nice gain, better financing, slightly higher income, buyers made money. Well, fast forward to, 2020, whisper on that deal is probably 137-ish a door.
Wow.
Maybe goes a little higher than that. It's in better condition in 2020 than it was in 2005. Certainly the units are much nicer. The exterior, everything about it is much nicer. And the area is every bit as good, if not better, than it was back then. Average rents now are $1,200.
Okay.
Right. So almost double, not quite double, but some of the floor plans are double. And then the debt is 2.8, 2.9% with
IO.
with multiple years of IO. So that's the formula, and that's a pretty good picture of how the market has changed over time. Dallas back in, remember my talk track in 04, 05 is, well, you don't come to Dallas for appreciation, you come here for cash flow.
That's right.
Right. These California people flocking here, they got appreciation out there, but they didn't make any money. So here you come to Dallas, you made your money out there, now come here and put it to work and make cash flow. Obviously now here you're getting appreciation, but you're also getting cash flow because the debt's so good. So that's what's really driven it. I mean, if your debt was 6.8%, what kind of cap rate would you have to buy the deal at for the math to work?
Probably a 10 or
right.
better.
I mean, they're deals that we underwrote in the 9.5, 10 cap range back then.
Yeah, because if you're seven amortizing, I mean, your debt constant, 9.
Yeah. I mean, it's not a lot of positive leverage there. So yeah, I mean, obviously 2.9% with IO and much higher rents is, you're probably making more money on it today than you were then, even though your basis is
100,000 more.
Yeah, 100,000 more a unit.
I think that really perfectly encapsulates what's happened in your and my career. That,
totally.
That was a local guy who sold it to probably some 1031 California buyer in 2005. I don't know that, but I'm assuming it was probably that was the scenario. Who had some duplex or a 10-unit building or something in Huntington Beach, California, wanted to come to Dallas for the yield and went from a 5 cap to a 10 cap back in 2005. And generally the workforce housing market, broadly speaking, rents have doubled and prices have tripled. And a lot of this is debt driven. That's really driving it down. And I don't know if you have a different opinion, but I mean, I don't think the consensus certainly is. And I don't think anyone really has an opinion that the interest rates are really going to go up. If anything, I mean, the last 12 months, we've seen interest rates go down, right?
Yeah.
I mean, the debt's much more attractive. What was like a typical debt term a year ago on something you were selling?
Well, I mean, yeah, it probably is the same
4%?
or higher. Yeah. Maybe sub 4, but somewhere around there. And I mean, I can remember the first time that I remember somebody locked a rate in years ago, and it was like 4.8. I'm like, oh my goodness, I can't believe you got an interest rate that starts with a 4.
Yeah.
I mean, I just thought that was mind blowing, right? I mean, but when I started, it was sub 7, right? So it's dramatically different on that front. But
so what I'm thinking is going to have to happen is, right now we've seen prices kind of basically stay flat throughout the year. We haven't seen too much movement one way or another. Maybe generally pricing kind of going up a little bit, but it's generally pricing is pretty similar to what we were a year ago. But the interest rates are down, 25-30% from where they were. So I think we're starting to see these prices kind of creep up. So one or two things are going to have to happen, because we just bought a brand new Class A deal, Nick, that we got, pushing 80% leverage on a 2016, 2018 vintage deal. When's the last time you've seen 80% leverage on an 80s deal, let alone on a brand new construction deal? So that tells me one or two things has to happen. Either interest rates have to go up, which I don't think anyone thinks, or cap rates have to go down. I mean, that's kind of what I think is going to happen in the future. Any thoughts or comments on that?
No, I 100% agree. We used to do, for our Marcus and Millichap conference every year, we do a survey, and it was basically one of the questions on that survey was, what do you think the biggest risk is in the DFW multifamily industry right now? And the interest rates, property taxes, expenses rising, payroll, every year interest rates rising was always runaway choice for everybody's biggest concern, and that has shifted entirely. I mean, that wouldn't even that may be the lowest thing chosen if you were to take that survey today. It was the last year we did it. It was certainly not the winner. But yeah, I think there's far more concern about a lot of these other areas and variables in the multifamily space right now.
I'll bring this chart up that I've seen recently, where it was like what actual interest rates did, and then at the same time it kind of showed what expectations were, and you kind of see this chart kind of goes up and down, but generally speaking, the interest rates are going down, and the forward expectations at the time always tails up. It's just amazing to think that we've been thinking for the last, the entire time you and I have been in this business that rates are going to go up, and they just never do anything but go down.
Yep.
It's just been crazy. It's really the evolution. So maybe kind of as we kind of get towards the end of the conversation here, maybe we can start talking about some actual practical things. That's what I always like to try to leave viewers of the show with is, what are some of the mistakes that you're seeing potential buyers when they're underwriting these deals? What mistakes, in your estimation, if they do make them, what do they kind of center around? Maybe one or two things.
Yeah, well, I mean, I think the obvious one is undercapitalizing the deal up front, especially if you're in the B or C world. A deals maybe less so, but the reality is when you get 2 or 3 years in and realize, man, I really wish I had this money to do this, you'd have been so much better off just getting that money at the beginning. It's so much harder to go back afterwards and do that. And so I would, without question, that's the number one mistake that I see over and over again. The second one, which is probably 1B, is putting the wrong type of debt on it. And I know you know this. I've done this. I've done this myself as well. And I have a front row seat to watching people make this screw up all the time. But I'll just put it this way: I don't know anybody that's put a floating rate loan on a deal that's like, I wish I wouldn't have done that. Yeah. And the good news is I feel like people have wised up, but I think so many people think, well, I'm going to be it's easy to do a 12-year or 10-year. I'm going to be a long-term holder.
Yeah.
And then they don't realize after 3 or 4 years, well, man, we're crushing our expectations. Maybe we ought to take advantage of this market. Yeah. And then they're stuck. You can't do it. And I mean, in this market, in the last few months, the deals that we've had that have been offered all cash, new financing, have been off the charts, record breaking in terms of the activity on it. The deals that are assumptions people will look at, but the dramatic difference in activity and ultimately pricing is you can't ignore it. So I would say, matching the debt, and if people believe what we're talking about here, that the rates are not going to rise, you put a cap on it, float it, and give yourself all that flexibility, and you will not regret it. And then I would say just one third thing is not managing the equity expectations properly, overpromising returns, putting a pressure on the property, on the management that doesn't need to be there. The reality is, as hot as the market's been, if you buy a good asset, operate it well, I would say most people have a reversion cap rate that's higher than what they ultimately end up selling it for. And so the deal is going to work, and it's going to work out well, and people are making money unless they're just stress their model so much at the beginning that they've set themselves back before they've even started the process. So those would be 3 things that I would say to really kind of focus on. And if everybody did that, I think they'd be in a pretty good place.
What's your what's got you losing a little bit of sleep, if there's anything? What's the biggest risk to our market in your estimation right now?
I would say I don't see a lot of risk. I feel very fortunate to be here. I mean, obviously the values are inflated, and and I'd say inflated relative to maybe historic performance or whatever. Cap rates are lower, values are higher. I mean, I illustrated that with the history of that deal. But the rents are there, the performance is there. So I would just say, getting to the point where too many people maybe are uncomfortable, maybe would be a risk. I think for us, being in secondary markets, and that's why we've invested so heavily in those markets, to just give people an alternative. Hey, if we're to the point where just uncomfortable in Dallas, and I don't see this as being the opportunity that I want it to be, maybe I'm not making as much yield as I would like to make, even if my overall returns are there. We have other options where you can get that yield. But I feel really fortunate. I think the population is going to keep growing. I think the business climate is fantastic here, and I don't anticipate that changing. We still got plenty of land.
That's right.
And the developers are still throwing up. And if you really want to get into the specifics, building costs are not going down.
No.
And in fact, quite the opposite has happened during COVID with the supply chain issues all over the world right now. Building costs are very high. Lumber's very high. It's hard to get appliances. I mean, you could go down the entire construction materials list, and in order for those deals to work, they got to charge really high rents.
Yep.
And that's only a good thing for Class B and C property owners, because as that gap increases, that's where we can keep pushing rents up and
and drag the workforce housing up with the institutional product.
Yep.
What risks do you hear from your clients that people are worrying about that you think that they shouldn't, that they're kind of fears misplaced?
I think there's a lot of people who've been around this market for a long time, and they think I can't buy right now. How many times in the last 5 years I'm waiting for the market to reset? Right. Well, if there was ever going to be a reset, I think we just went through it, and we're already out the other side of it. And I don't want to say it's totally behind us, but in spite of all this, I mean, we will be up over last year in terms of what we do, both on a number of deals, on a volume, every way we could measure it, we're up. And with our team growth, we're going to be up again next year. So despite the world shutting down, not just some sort of event in the U.S. or whatever, or a local event that caused, I think we've come out and the fundamentals are still there and they're still strong. So I think for people that are sitting on the sidelines saying, hey, I'm waiting for a reset, I'm waiting for values to go down, I think you may be waiting a while. And so you either adjust to the times, the equity has adjusted, certainly. I mean, people were wanting a 2X and maybe now they're happy for a 1.8, and that's fine, right? I mean, there's money to be made there. And then for folks that don't like that, look in other markets, look in other opportunities, because they're out there. I some of the craziest deals we've seen this year are in some secondary markets, and I would be happy to tell folks if they want to contact me about some of those stories. But like, we just sold one in an Oklahoma market that their first month of collections, haven't done anything to the property yet, the income was up $17,000.
Oh wow.
1 month, from basically high 70s to mid 90s, 1 month.
Yeah.
So just with better management, better team on site. So you're more likely to find some of that kind of stuff in some of these other markets. You're not likely to find something that's just been grossly mismanaged in DFW. Not to say it's impossible, but it's a lot less likely. So
maybe kind of last question before we wrap up here. What separates, in your estimation, you observe a lot of different operators out there. You've done 500 plus transactions at this point. What separates the better multifamily operators or owners or investment groups versus the ones that tend to struggle or fail?
Well, I would say attention to detail is huge in my mind, and it's hard to. I think it's almost a trait. I got to be thoughtful with how I say this. My kids don't have great attention to detail all the time. I still have hope for them. But I was going to say, I guess by the time you get to be 25, 30 years old, if you don't have it, the odds that you ever do have it are probably not great. Hopefully that's not the case for our children. But if an on-site manager doesn't care, that I don't think your property is not going to do well. So if your management company can create a culture where they're not just, hey, it's hard to find a maintenance guy, so we're going to just live with this maintenance guy that's not great, or it's hard to find a new manager, or this manager's not making that much money, so this will help us meet our budget if we keep this person, but they're not that great. Like, if you're willing to settle for not that great, then you're going to get not that great results. And so there's some companies that their culture is so great, and people are genuinely proud and enthusiastic to be a part of that. And I just feel like that flows through the P&Ls. Right. You walk by a little piece of trash and you pick it up, right? Yeah. Or you've been on plenty of property tours where people just walk right by and pretend like they don't see it, right? So I think that's a big deal. And from an owner operator standpoint, right? Are you a part of that, right? And when you go to your property, do you see and observe that? And is the expectation being met? And what does your model unit look like? What do your laundry rooms look like? And these are just simple, quick eyeball test things. You could dig into the GL and you can see, are we paying our vendors on time? And you can look at a lot of different factors like that. But at the end of the day, that culture of do I want to be a part of this? And am I proud to be a part of this? I think that's what truly separates the people, because guess what? The big owners out there, and you would be included in that group, you don't hear about, oh man, they just totally laid an egg on that deal. No, because you have a culture, you know what you're doing, you're not making those mistakes that I talked about earlier. And then when it comes to operating, you're thorough and you have an expectation, and it's a high, and so I think that's important, and it's not easy to achieve. If it were easy, everybody would do it, right? So I think that's probably what I would say more than anything else.
Well, Nick, appreciate your time today. People want to find out more information. You guys, if anyone's out there looking to buy multifamily workforce housing in particular in Texas and North Texas, secondary markets, Dallas-Fort Worth, Nick sells almost as much as anyone in town. What's the best way for people to get more information about you guys? Yeah,
the quickest way that somebody could reach us would be on our website, multifamilyadvisors.com. We do text alerts, which I think is really effective. It's easy to miss emails. So if you want to sign up for our text alerts, you could certainly do that on the website as well. And you could reach out to me directly. You could reach out to me, and I can put you in touch with some of the other guys on our team. If there's a specific market or a specific property type you're interested in, I think that'd be fantastic. I would tell people that maybe are watching this or listening and say, man, how do I even get started? Call us and look at our 75 unit and under stuff. That's the whole idea behind that, is to get your feet wet, and then you can grow into to being a bigger, more sophisticated investor. So we'd love to help in any way possible.
So Nick, appreciate it so much. So for Nick Fluellen and Michael Becker signing off. See you guys next week.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.